Welcome to When Good Things Happen, where our mission is to inspire people to discover and learn about all the things that can really make the golden years the very best of your life and share a few financial ideas to help you make your vision for retirement a reality. Host Tom Gandolfi is your guide on a how-to adventure to help enhance your retirement lifestyle.
Hey everyone, this is Tom Gandolfi again. Thanks for joining us for the podcast. I'm pretty excited about our guest today. You know, real estate has been certainly the talk of 2021 so far, and the market's been really, really hot, and people are moving, people are refinancing, mortgage rates are historically low, and people are looking for opportunities. So I thought it'd be really helpful to folks that are listening to bring someone in who is really able to talk as an expert on the subject. I've got with me today Brian Yearwood, and Brian is in the mortgage industry, and we're going to have a conversation about the market and some things that you might want to consider moving forward. You know, when you get into retirement, one of the things that people consider is downsizing, or in some cases upsizing, or maybe just relocating. Maybe they want to go live by a lake or in the mountains or the beach or whatever it may happen to be. Maybe they want to move out of their house that's got 3 levels into something that's a little more manageable. Maybe it's a one-level ranch that is a little easier to navigate and a little easier to take care of, and that's going to obviously involve some processes. And, you know, with rates being as low as they are, people have to make a choice at this point as to how they want to handle their real estate transactions. And certainly if you're moving from one home to another, and if you're getting close to retirement, you might be at the point where you've paid off your house and you know you've got this nice little stack of equity that you've built up in the home, and you might be thinking about whether or not you want to take on a loan, or maybe you want to pay cash. In years past, that might have been sort of a no-brainer, but I think as the market has changed and rates have stayed so low for so long now, you might be surprised at what might be in your best interest. So, Brian, thanks for joining us today.
Thanks for having me.
Absolutely. So, you know, the market's been red hot. I'm sure you've probably been a pretty busy guy now for the last, I don't know, however many months you want to count back.
It's been nuts.
Yeah, it has been. And that's a good thing. You know, people are really benefiting from this low mortgage rate environment in some ways. You know, the interest rates have been a challenge. You know, low interest rates are great when you go to buy something. They're not great when you want to try to save some money, and that's made planning for retirement a bit of a challenge. You know, if you want to make a return, if you want to make a decent rate of interest on your money at this point in time, you have to look at risk options. So we have to deal with that on the investment side of things, but at least on the mortgage side of things, we're going to benefit from these low rates. So what's going on? What's sort of the state of the market as we're talking here today?
Well, rates were low-ish prior to COVID, and then COVID, with all the economic consequences that came with that, it drove rates ridiculously low. And we thought going into this year, rates would start to nudge up quickly, which they kind of did. I don't know, late December, early January, around the election time, rates probably went up 0.5 point. So it really slowed things down, although there were still a lot of people that needed to refinance. But then they kind of settled back in, and it just slowly drip, drip, drip. We're still not down to the lowest point we were at during COVID, but we're pretty close. A 30-year is not as low as it was. A 15-year is at the low point, and has been holding steady for a while. So it's been interesting. You know, it was a great time to buy a house before we had all these supply issues. Now, I think it's a horrible time to buy a house. You know, on one hand, you're getting a great rate. On the other hand, you're paying an all-time high for prices. So that's a long conversation I have with a lot of people. It's a great time still to refinance. There are a lot of people that come to refinance and say, okay, we don't want to move, but we do want to put some of this equity to work. Well, you know, it can be dangerous to pull that money out and invest it. And it depends on what age people are at. So what I do involves a lot more financial planning than you would think. Now, I try to leave that to the professionals. You know, the extent of my financial planning is really kind of Dave Ramsey world. You know, where are you with debt? Where are you with 401k? I get a lot of people that come to me that have been aggressively paying extra on their house, paying down on their mortgage, and don't participate in their 401k. They want to do a 15-year fixed, and we have that conversation. Hey, you've got $800 a month to put in this bucket that you're putting into your house, but your company has a 401k that matches 5%, and you're not putting that $800 into that bucket.
That's free money.
It's free money, not to mention the tax savings. And when I run those numbers, a lot of times I talk myself out of a refinance, but I've created a client, for longer term because of that. There are a lot of times when somebody can do a 15, they're maxing out their 401k. I've had it happen where they can do a 15, and it is a better return than even the company match and the market returns in the 401k. So we look at the whole picture to try to figure out what best suits them. And a lot of times lately, people are going to 15-year fix. And surprisingly, we're still not doing that many purchases. I read somewhere recently, it's like, imagine there are 100 cars for sale on a lot, and there are 300 car salesmen. Yeah. And that's houses versus real estate agents. Yeah. There's just, most agents I know are not busy because there's no supply.
Inventory, right, yep. Right. Well, you mentioned that, sometimes you've got to make recommendations that don't necessarily wind up in resulting in a deal for you or a new client. But I mean, really, with what you do and what I do, that's what this is all about. You've got to do what's right for the client first and foremost, and the rest of it will sort of take care of itself. And, when rates are low, running out and refinancing is, a good idea for many people, but in some cases it's not. So I think it's really great that you'll try to take a look at this from a holistic standpoint and really make a recommendation based upon what's good for them. So that's really, really good. It's
cost benefit. The first thing I do is calculate what their savings may be, what their cost may be, come up with a break-even point. And it's funny. We used to have, I've got a business partner. We've been in business 20 years. In June was our 20-year anniversary. Most partnerships don't last that long. Right. At one point, we had 31 loan officers, and I just really didn't want to manage. I like the relationship, so it's he and I, and it's been he and I for the last 7 years, just a two-man shop. We do a lot of volume, but I like that individual, controlling the process and doing what we know to be right. But I used to tell loan officers when we had them, maybe 1 out of 5 calls would turn into a deal. Mm-hmm. 3 out of 5, you're giving advice, but those people are in your tree to go tell other people about you. 1 out of 5, you might lose the deal because the borrower's brother-in-law was in the mortgage business. Right. And 1 out of 5, you do the deal. I tell people my job is to talk on the phone and give advice, and it turns into loans.
Well, and I can say this with conviction. I've sent some people to you to check into what might be in their best interest in terms of refinancing or doing a new deal on their house, and you've handled every one of them with a high level of professionalism, and you've done it in a. Funny enough, you mentioned you're not a financial planner. You've done it in a way that incorporates financial planning. You've involved me. You've made some recommendations that are more big picture based rather than just focusing on your home mortgage deal, which is really important.
Well, that's the key thing to remember. I tell people that want to get in this business, you have a chance to shine because this will sound terrible, but I'm swimming in a sea of idiots. Mm-hmm. It's a 40-hour course. You have to have a high school degree. You have to take a 40-hour course to get your mortgage license. Mm-hmm. There are a lot of people that are not qualified. I've got an accounting background. I've got a sales background and have picked up the financial planning piece just over the years from managing my own and volunteer work and things like that. But, you could call one of these big national lenders and get a guy 2 years out of high school that's got his license. I don't think he's probably qualified to give good advice, but he'll be happy to do your loan for you.
No, we do deal with some of that in this business too. And, it's a little frustrating because, when I come into work every day, I am absolutely aware that I am dealing with people's life savings. And in your field of business, the home mortgage industry, you're dealing with what is most likely one of their most valued assets. It's their home.
And their biggest debt.
It's probably their biggest debt. It might be their most valuable asset. And even maybe more important than that, it's where they live. And all of this craziness that we go through every day with working and putting in the hours and saving money and investing and building financial plans, at the end of the day, it's really about the lifestyle that we want. And, you're dealing with helping people sort of fit into the lifestyle they want. I do the same thing. So. Yeah. It's really good. You mentioned a little earlier about some people come to you and talk about taking cash out of their house and investing. And I think it's pretty risky business. That's not something that I'm a real strong advocate of. I get the question from time to time myself. And, it'd be really easy to say, oh yeah, take all that cash out and let's throw it into the market. I don't do that. I don't think it's a good call. Look, the market has been an amazing tool for Americans for over 100 years. However, when people are in a position in their life to be taking cash out, doing cash out refinances, or taking cash out of their house, they've probably reached some level of financial accomplishment. And they're probably a little later on in their career. They may be not retired yet, but maybe they're within 10 years.
Right.
Look, the stock market is not a predictable beast in short runs. It's just not. And anyone who tells you that it is full of it.
Let me correct what I said earlier. I get less inquiries about pulling money out to put in the market, and more of someone selling their house for $600,000. It's paid off, and they're buying the next house for $400,000. They're downsizing, which I hope to be doing in 23 months and 4 days to be exact, when my youngest graduates high school.
I've met your wife. Good luck with that.
Well, no, I will have cut the grass for the last time on that day. But more someone who's got their house paid off, they may want to pay cash for the next one. They've got the ability to pay cash for the next one, but their advisor might say, "Hey, rates are really, really low." Now, I get.
That's a little different situation.
If you can do a 15-year at 2%, why would you plop down $500,000 when you might want to do a loan? I think it's a balance. Dave Ramsey on one. Let me say one thing. I use his name a lot because we go to one of the large churches that I'm sure you've heard of here, and that's how I serve. And it's a Dave Ramsey curriculum, and I think it's wonderful. I really do. But again, it's basic stuff more for younger couples that are dealing with debt. Not the kind of folks we're talking about here, but Dave Ramsey would tell you at all costs pay off your house. Well, if you're somebody that's not disciplined, you spend too much on cars, you get a little extra money and you blow it. I agree.
It makes some sense.
You got to follow discipline and pay the debt off. Somebody that's disciplined, they've got great credit, they've got assets, they've got their house paid off. If your house is paid off, I can guess you've got an 800 credit score and you're probably pretty disciplined. I can credit profile. Yeah. But somebody like that, if you can get a 15-year at 2%, get a little bit more aggressive. That's a decision for the borrower and his financial planner. And I always defer to them and say, hey, you may want to consider this because it's almost free money. It's your only tax deduction you've got. Your effective rate after taxes might be a 1.25. That's not real aggressive to put that money in the market to make.
No, that's a different situation. You're talking about creating an opportunity in which you can generate a positive arbitrage. So, right. And for those of you who are wondering, well, what the heck is that? So a positive arbitrage is basically the return that you would make above the rate of interest you're paying for the money you've borrowed. So, for example, if you've taken out a mortgage and the mortgage has a 2% fixed rate, maybe it's a 15-year that Brian just referred to, something along those lines. Well, if you can find an investment that creates an opportunity to generate more than a 2% return, and it could even be a fixed investment with no risk. Even if the positive arbitrage you create is only 0.5% or 0.75% or 1%, you have to take a look at that because now you're making money on the money you've borrowed. And that's sort of the business that banks are in. And last time I checked, the bank is the biggest building in every downtown across the country. So they're doing something right. If you can make money on money that you don't have in your possession because you've borrowed, you've got a pretty good situation going on there.
Yep.
You just got to do it with a very risk-averse approach, and you have to understand what you're doing. In the situation that you mentioned, someone sold their house for $600, they want to buy a new home, and they're downsizing, they're going to pay $400 cash for it. Well, they could do that, certainly. But, cash is power. There's no question about it. And if you can get into a situation where you go ahead and you take a shorter-term mortgage at a very, very low rate, and you can make 3 or 4% as an example, nothing is obviously guaranteed or implied here. If you can make a return that's above the interest rate you're paying on $400,000, you may find yourself in a much better place than you thought you could be. So this is why it makes sense to look at all options, because different options are going to be the right answer for different people. Agreed?
Exactly. And a lot of times, though, I'll answer my phone. Someone goes, Hi, my name's John Doe. I was given your name by so-and-so. What's your interest rate today? And okay, we need to know more of your circumstance.
Yeah. Well, there's a menu there to interest rates too. Closing costs are involved, and people sometimes, if they can work with someone like yourself who's willing to take a little bit of time to figure out who they are, what they're doing, what they're all about, and what their goals are, you can actually create a situation where you can recommend a lowest cost option for them that may not necessarily be the lowest interest rate.
Probably 95 times out of 100, it's not.
So can you explain that to us just a little bit?
So you need let's use a round number, $500,000 mortgage. On a 30-year fix today, 2.75 is probably what we call the par rate. That's the rate the lender wants to get. They're not charging you discount points. People call and say, do you charge points? And I know right away they're not that educated when it comes to mortgages. You can pay points, you can pay no points, but still have closing costs, or the lender can pay you points. There's discount points in reverse. It's called a lender credit. So let's say 2.5, you're paying points. You might have $10,000 in closing costs. 2.75, you're paying no points, but you got about $5,000 in closing costs. 3%. Now that lender's getting more. 2.5, they're not getting the rate they want to get. So they're going to charge you discount points to make that yield better on that money they loan. 2.75, hey, that's the rate we want. We're not charging you. We're not paying you. 3%, they're going to make a premium on that interest, but assuming that interest or that mortgage services for 7 to 10 years. So they're going to make more in interest. So they're going to give you a credit that we use to pay your closing costs. Now, that's a gamble for the lender. They really need to, the break-even point that I calculate is how long the lender needs to service that to start making more money. So that break-even point, not to get too technical, but long-term yields have been better than short-term yields for a very, very long time. In a healthy market, the break-even point between paying cost and not paying cost is typically 38, 40 months. So you or me at our age, have you downsized yet?
I have not.
You should. I mean, you're empty nesters, if I recall.
I am.
So
just recently.
For me, when we downsize, the next house I go to is going to be the house where my wife has a hole dug in the backyard to bury me. I'm done moving. I'm done with all. So I'm going to be somewhat permanent. I look at 3 factors when somebody's picking the low rate versus high rate. Well, now with that break-even point being so long, everybody, they call wanting the lowest rate. When I lay the numbers out the way I do for them, they always inevitably take the higher rate because that break-even point is 82, 84, and 90 months. And my first question to them is, do you know you're going to be in that house 7 to 8 years? Well, we don't know, but we think, okay. Second question is, are rates really, really low? Well, that's certainly yes. You're less likely to ever refinance if you get a rate this low. And number 3 is a break-even point less than 5 years. Well, that's a no, and it's been a no for the past 4 or 5 years. So most people opt for that. Now, one other consideration in that, so I call it the naked break-even point. Let's say that's 84 months, 7 years. So if that difference in closing costs of $10,000, the break-even point's 84 months, but it doesn't factor in the opportunity cost, which is a term I'm certain you understand. You're going to take that $10,000 and pay it now to get that lower rate so that you save money starting in month 83. What if that money, that $10,000, stayed invested in the market and earned 3%? Well, you've now taken an 84-month break-even point, probably turned it into 15 years. You're looking at a 15-year mortgage, take the higher rate and be done with it.
Well, I'm glad you mentioned that and you touched on it because this is something I actually firmly believe in, and I already said it a minute or two ago, but, guy you might have heard in Warren Buffett always says cash is king. And it doesn't mean you've got to stick it under your pillow, but it means that if you have some of your funds available to make other investment decisions, you might wind up doing a little bit better than you would have had you just forfeited the cash on the front end.
Well, and Dave Ramsey calls that margin. Warren Buffett says cash is king. Ramsey says he calls it margin, and I like that term. You've got margin in your life.
Well, here's the deal too. If you go ahead and take a higher rate, I mean, let's be realistic about where we sit. a lot of folks that are listening to this probably remember where mortgage rates were back in the late 70s and early 80s.
I don't, because I was too young. But
you remember what they were.
Oh, yeah.
You've seen them. I mean, 13, 14, 15% rate on a house was not out of the question, sometimes higher. And people are getting, I think, a little bit twisted up because of the media, which is the root of all things evil nowadays. But they get twisted up because the rate's gone from 2.75 to 2.9. Well, really?
Yeah.
Let's try 13.65 out for a change and see how that feels. So, those are really, really good points. And, I can actually relate what you were just talking to maybe for folks that haven't gone through the refinancing and maybe haven't had to look at this, or maybe just haven't looked at it even though they have gone through refinancing. Think about it in terms of automobiles. This year's been a little different because, like everything else, automobiles are in short supply. But we usually get to late summer and all the automobile manufacturers start offering their deals to clear out the old models and bring in the new ones in the fall. So they usually offer, and the American car manufacturers for years were the worst about this, they would offer an $8,000 rebate or a $10,000 rebate or free financing for 72 months. And, well, I like free financing. Well, no.
Do the math.
So you got to do the math on it. And the cash is almost always going to be the right answer. And if you do decide, kind of going back to where we were with the whole downsize and do I pay cash for the new house, that might be the right answer for some people, and I would never discourage that. Some people just are more comfortable not having a mortgage hanging over their head. But I would challenge people to at least look at it both ways before they make a decision. If you keep the cash and take on a low-rate mortgage, as long as you're a responsible steward of the cash and you don't go put it all on black in Las Vegas, or red for that matter, you can pay off that mortgage at any point in the future that you want to pay it off because you've got the cash.
Anytime. And if you paid cash for the house and then decided 6 months later, I wish I hadn't, now it's a much more difficult task to get that money out. We don't know where rates are going to be. And I tell people when they're making this decision, I try to, they may have come from a family whose parents lived through the Depression. I deal with that. I'm dealing a lot now with my clients' children buying their first house. So you get a lot of how people were raised goes into their decisions.
Well, they saw the 2008 debacle.
Exactly. And what I try to do is determine, okay, here are the numbers. And I have a hard conversation with them where we determine, mathematically it doesn't make sense to pay cash for that house. And we agree it's an emotional decision, which I completely respect because you don't know what somebody's been through. But most of the time, when we whittle it down and peel back the layers of the onion and expose that it is purely based on emotion, not math, they go back and have that conversation with their financial guy. And a lot of times they will split the difference because what I try to make them understand is you can pay that down anytime you want. You can recast your loan. If you borrowed $300,000 of the $400,000 and then later on said, this payment's just a little, if they're on a fixed income, payment's a little higher than I'm comfortable with, take that $100,000, pay it down. The lender will recast your payment to what it would have been if you only borrowed $200 to begin with. A lot of options, but most people don't realize they have those options. That's why when somebody calls and says, "What's your rate?" I just chuckle.
Right.
Hey,
there's a lot of pieces to that.
Go on the internet. That's not how we work here. We aim to please, but it's like calling the doctor and going, I've got a lump in my side. What is it?
Right.
It really, you just can't.
It's a great analogy. You can't. You've got to dig a little deeper.
Yeah.
And and you bring up the fact that if you put all the cash in, it's a little more cumbersome to get it out. The mortgage process can be a little frustrating at times. That's why people need to find someone they're comfortable with, and I think that's really important. But not only is it a little more cumbersome to get the money back out of the house once it's in, now you got to pay interest on it. So you're paying interest on cash that could have been making interest. So it's something that people have to at least consider.
I use this analogy a lot. When we were younger, how old are you? We're close to the same age.
We're very close.
I think you're
absolutely.
older than me, though.
When
we were younger, and I tended to get a new car every 3 or 4 years because I cared about. A lot of boy, I love that car.
Oh yeah.
Can you get me in it for the same payment I'm making now?
Oh, yeah.
What's the cash flow?
Payments forever.
So a car payment, I've said this till I was probably 40. A car payment is a fact of life. It's not. It doesn't need to be, but all we cared about was cash flow. Younger families, younger people now call me, they want to refinance. All they care about is what their payment's going to. I get it. We all want to save $300 a month. I mean, that's free money that you can, they're not invested in their 401k. Hey, put that straight in your 401k. Don't use it, for more dinners and just more lifestyle. When you get to a certain age, hopefully earlier than better, I try to teach people to look at it from a net worth or a balance sheet perspective. Okay, you called me to save money. You're at 4.5 on a 30-year fixed. Your principal and interest is $2,000. I'm trying to tell you to do a 15-year and make your principal and interest $2,500, but you get an extra $1,500 a month in principal.
They don't like that answer.
And they're like,
right?
well, and then we have a long conversation. They may or may not go with it, but it gets them thinking. It gets them thinking. So and I tell them that's not a cash flow move. That's a net worth move. The smart ones realize how much they're leaving on the table by doing a 30 instead of a 15. And I tell them, I said, look, when I get you, Joe Blow Bar where you're 35, if I get you on a 15 at 2.25%, we are done forever until you maybe buy another house. That's one other thing. I'm going to take a little diversion. I'm really curious to see what these rates for this extended period of time do to the real estate market in the future.
It's going to be interesting
because more people are going to pay their houses off or down, and in the typical market, we bought our first house for $290,000. Had one baby, had another one coming, and our marriage was not going to last if we didn't get a bigger house. We bought the house we're in now. We've been there 21 years, had another child after that. Still don't have enough room, but a lot more room. But the move up buyer that most young couples are, you buy your starter house, then you sell it and you make a profit. You get into the next one. Somebody buys a house for $300,000 and their rate's 2.25%, and then 4 years later, when they're ready to move, prices have continued to go up. They're going to spend $600, but rates are now 6%. I don't see people. I mean, I think a slowdown is inevitable because so many people are at such ridiculously low rates. I think if rates go to 6%, which winter's coming one day,
it's going to kill housing values.
I just don't see how anybody's going to make a move because why would you, unless you own your house free and clear, and then you're going to steal the next house. I don't know. I'm curious to see what the next 5 years brings.
Yeah, it's going to be interesting to see how that unfolds. So if somebody wants to kind of start the process. Maybe they're looking for a house. Maybe they're just kind of kicking the tires because their house is worth a lot of money and they really want to see what they could do. Or if someone maybe wants to look at a refinance, what do they have to prepare? What should they get ready and
the greatest thing somebody can have in their hand, they'll call and say, I want to refinance. I hear rates are low. Well, what's your rate? I think it's, 4.5. I'm not sure. Have a mortgage statement in your hand when you call. I take notes. You should see my desk. I've got that legal pad. I write their name down. I file them alphabetically. If you called me 5 years ago, I've got the page I spoke to you about. But, I write down where you're at. You might think, well, I'm at 3.5 and I hear rates are 3. That's probably not worth it. Well, if you owe $85,000, it's probably not worth it to refinance. But if you owe $300,000 and you can come down a half point, even a quarter point with no closing costs, it probably is. One frustrating thing I hear from pundits that give mortgage advice is that you need to be able to drop your rate by 1% to make it worthwhile. That is so untrue, and that's back in the day where you had to pay all your closing costs. So if you're going to spend $5,000 in closing costs to save, $1,000 a year in interest, maybe you need to come down a point to make that worthwhile. So to wrap up my long-winded point, don't make that decision yourself whether or not you need to refinance. If you've got any inkling that it might be worthwhile, call somebody, have a discussion. Just remember, 9 out of 10 lenders would be happy to talk you into a refinance whether you need it or not. So it's basic math, and whoever you speak to, make them back it up with the math. What's it going to cost? What's it going to save?
Well, great points, Brian. I'm glad you stressed the fact that this needs to be right for the client. I'm glad you covered a lot of ground today for us. So the environment and the interest rate market that we have right now is really attractive. If you're thinking about buying a house, or if you're thinking about selling your house, or downsizing, or relocating, or refinancing, you need to get in touch with someone that can at least provide you with some information and educate you a little bit on what might be the best decision for you. So Brian's company is Custom Mortgage Services. They're right here in North Atlanta, and I'm sure he'd be happy to take your call, have a conversation, and really kind of dive in to see what's right for you. So Brian, how can they get a hold of you?
Telephone 678-992-7100. We're there Monday through Friday, probably 8 o'clock till 7 o'clock. It's been busy. Try to get away on the weekends, but if you leave me a message, I typically call you back over the weekends too. So
great. Well, you've done a great job with everyone I've sent your way. So if you're listening and you're interested in at least looking to see where you stand, feel free to give Brian a call. He'll be happy to help you out. So we're going to wrap it up. Thank you for joining us today. I really hoped you enjoyed this episode of When Good Things Happen. I know I enjoyed doing it, and mortgage interest rates are really attractive. I thought this was a great topic to do. Can't wait to get back on it next time, so stay tuned for the next episode. Appreciate it.
Thank you for listening to When Good Things Happen. If you enjoyed today's show, visit whengoodthingshappen.com to share your retirement lifestyle dream, access information about our guests, and sign up for our newsletter. Be sure to rate and review us wherever you listen to your favorite podcasts. Three Bridges Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management LLC, AEWM. AEWM and Three Bridges Financial Group are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Three Bridges Financial Group is not permitted to offer, and no statement made during this show shall constitute as tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Three Bridges Financial Group.